The average new car payment in America right now is $767 a month. Nearly 1 in 5 new car loans has a monthly payment over $1,000. And more than 22% of buyers are signing up for 84-month loans, 7 full years of payments, just to make those numbers fit their budget. That is not a car payment. That is a second mortgage on a machine that loses value every single day you own it. But here is the part that nobody tells you at the dealership. It is not just the price of the car that is draining your wallet. It is a system designed from the moment you walk through that door to squeeze every possible dollar out of you in ways you will not notice until you are already locked in. The finance office is not there to help you. It is there to profit from you. The tricks they use are so effective that most buyers drive off the lot, genuinely believing they got a good deal. The reality is they just signed away thousands of dollars they did not have to spend. Today I'm going to break down exactly how this trap works, the specific tactics dealers use to inflate your cost without you realizing it, and the exact steps you can take to protect yourself before you sign anything. If you are thinking about buying a car anytime soon, this might be the most important video you watch before you walk into that dealership. Subscribe if you have not already. We break down the stuff about cars that nobody else is willing to say out loud. Let's get into it. The first thing you need to understand is how a dealer makes money on your financing. Most people assume the dealer just connects you with a lender and moves on. That is not what happens. Dealers submit your credit application to multiple lenders, and those lenders return an approved interest rate based on your credit profile. That approved rate is called the buy rate. It is the real rate you qualified for. But the dealer does not have to show you the buy rate. Instead, they mark it up. They add 1, 2, or 2.5 percentage points on top of what the lender approved, and they keep the difference as profit. That markup is called the dealer reserve, and it is one of the biggest hidden costs in the entire car buying process. To make this concrete, imagine you are financing $40,000 over 72 months. The lender approves you at 5%, that is your buy rate. But the dealer marks it up to 7% and presents that as your rate. You never see the 5%, you only see 7%. That 2 percentage point markup costs you roughly $2,600 in extra interest over the life of the loan. Pure profit for the dealer, taken straight out of your pocket and completely invisible unless you know to look for it. The Consumer Financial Protection Bureau has acknowledged this practice. They have said that dealer-arranged financing may include compensation tied to interest rates. It is legal in most states. It is industry standard, and it is designed to be invisible to you. This is why the single most important thing you can do before you walk into any dealership is get pre-approval through your own bank or credit union first, not the dealer's bank. When you walk in with the pre-approval letter, you already know your real rate. When the dealer offers you financing, you have a benchmark to compare against. If their number is higher than yours, you will know exactly how much markup they are trying to charge. You can negotiate it down or walk away and use your own lender. That one step alone can save you thousands of dollars. Most buyers skip it because the dealer makes financing feel easy and convenient. That convenience is the trap. The second tactic is even more dangerous because it sounds so reasonable. The dealer shifts the entire conversation away from the price and onto your monthly payment. Early in the process, they ask one question: what monthly payment are you comfortable with? The moment you answer that question, you've lost. Now the dealer is not working to get you a fair price on the vehicle. They are engineering the loan to hit your target payment no matter what the total cost is. Here is how it works. You say you want to stay around $500 a month. The dealer can make almost any car fit that number by stretching the loan term. Instead of 60 months, they put you on 72 months. Still too high? They go to 84 months, 7 years. At every step, the monthly payment looks fine. It fits your budget. You feel good about it, but you never looked at the total cost, and that is where the damage lives. Edmunds reports the average finance cost of a new car on a 60-month loan was $38,205. Stretch that same purchase over 84 months at a higher rate, and you are paying thousands more in interest while driving a car that is depreciating faster than you are paying it off. This is where the third trap kicks in, and it is the one that keeps people stuck in a cycle for years. Negative equity. Negative equity means you owe more on the car than it is worth, and it is happening at a record pace. According to Edmunds data from the third quarter of 2025, 28.1% of all trade-ins had negative equity. That is the highest ratio in 4 years. More than 1 in 4 people trading in a car owed more than the car was worth. Now here's where it gets ugly. When you trade in a car with negative equity, that leftover balance does not disappear. The dealer rolls it into your new loan. So now you are financing the price of the new car plus the debt from the old one. Your loan to value ratio goes through the roof, your interest rate goes up because the lender sees more risk, and your payments climb even higher. Edmunds found that borrowers who financed with negative equity paid an average of $15,881 in interest over the life of the loan compared to $9,619 for borrowers without negative equity. That is a $6,200 penalty just for being upside down. And the longer the loan term, the more likely you are to end up in the same position again when you go to trade in the next car. It becomes a cycle. Roll the debt, extend the term, pay more interest, lose more equity, repeat. Now, before we get into the finance office tricks, take a second and hit that like button. This is the kind of information that saves people real money, and one click helps get it in front of more drivers who need to hear it. All right, let's keep going. Once you have agreed on a price and a payment with the salesperson, you get handed off to the finance and insurance office. Most buyers think this is just paperwork. Sign here, initial there, drive away. It is not. The finance and insurance office is its own profit center within the dealership, and the person sitting across from you has already studied your deal before you walked in. They know the price you negotiated, your down payment, your credit profile, your trade-in value, and your preliminary financing terms. Their job is to maximize the dealer's profit using everything they know about your transaction. How do they do it? add-ons. A menu of products gets placed in front of you. Extended warranties, gap insurance, tire and wheel coverage, paint protection, fabric sealant, key replacement plans, windshield protection, roadside assistance, and maintenance packages. Each one is presented as a small, reasonable addition, just a few dollars a month folded into your payment. What is another $15 a month for peace of mind, right? But those small amounts stack fast. A $2,500 extended warranty, a $900 gap policy, a $400 paint sealant, and a $300 key replacement plan just added $4,100 to your financed amount. That is $4,100 you are now paying interest on for the next 72 or 84 months. By the time the loan ends, those add-ons have cost you closer to $5,000 or even $6,000 when you include the interest. Industry data shows that finance and insurance add-ons can inflate the total vehicle cost by 10 to 20%. And most buyers do not push back because they are tired. They have been at the dealership for hours. They have already committed emotionally to the car. They just want to finish and drive home. That fatigue is part of the strategy. The longer you sit, the easier you are to upsell. Some of these products have value. Gap insurance can be genuinely useful if you are putting minimal money down and financing long term, because it covers the difference between what you owe and what the car is worth if it is totaled. But you do not have to buy it from the dealer. Your own auto insurer or credit union almost always offers the same coverage for a fraction of the price. Dealers sell Gap at massive margins. It is one of their highest profit add-ons. The same goes for extended warranties. If you decide you want one, get the price in writing from the dealer. Then call 2 other dealers and compare. You can often purchase the exact same manufacturer backed warranty from a different dealer at a lower price, and it will be honored at any dealership nationwide. And then there's one trick that can blow up your entire deal after you have already driven the car home. Spot delivery. This is when the dealer lets you sign a contract and take the car before the financing is actually finalized. You think the deal is done. You have the car, you are showing it to your neighbors. Then a few days later, the dealer calls and tells you the financing fell through. You do not qualify at the rate they quoted, but do not worry, they have found another option. The new option just happens to be at a higher interest rate, a longer term, or both. This is called yo-yo financing and has been the subject of enforcement actions by the Federal Trade Commission. The play is simple. Once you have had the car for a few days, you are emotionally attached. You do not want to bring it back. The dealer knows this, so they have leverage to push you into worse terms than what you originally agreed to. In a legitimate situation where financing truly falls through, the contract should have an owner's right to cancel clause that lets you return the vehicle and void the deal. But many buyers do not know that clause exists, and many dealers do not volunteer the information. The way to protect yourself is to never leave the dealership without fully approved financing, not pending approval, not subject to lender confirmation, fully approved, fully documented, every term locked in writing before you turn the key. If the dealer says you can take it home now and they will finalize the paperwork tomorrow, leave the car there and come back when the paperwork is actually done. So here's what you do to protect yourself before you ever set foot on a dealer lot. Get pre-approved through your own bank or credit union. This takes an hour and it gives you a baseline rate that the dealer has to beat. Never answer the monthly payment question. Negotiate the out-the-door price first. That is the total cost including all taxes, fees, and charges. Get that number locked before you discuss financing at all. Keep your loan term to 60 months or less. Yes, the payments are higher, but you build equity instead of losing it. You pay dramatically less interest, and you avoid the negative equity trap that catches people on 72 and 84-month loans. In the finance and insurance office, say no to everything you have not researched independently. Ask for any product you are interested in to be quoted in writing, and tell them you will compare before deciding. There is no rush. If they pressure you, that is a red flag, not a reason to sign faster. And never drive the car home on a spot delivery without fully finalized financing in your hands. The car payment trap is not one trick. It is a system. Rate markups, payment-focused negotiation, stretch terms, negative equity rollovers, finance and insurance upsells, and spot delivery pressure all work together. Each one by itself might cost you a few $100s. Stacked together across a 7-year loan, they can cost you $10,000, $15,000, even $20,000 over what you should have paid. And every dollar of that goes to people who are trained to make sure you never notice. Now, if this video saved you money or opened your eyes to something you did not know, smash that like button so the algorithm pushes this out to more drivers who need to hear it. Drop a comment and tell me, have you ever been caught by one of these tricks? I want to hear your story. And if you have not subscribed yet, now is the time. We have a lot more coming on this topic, and we do not hold back. We tell you what the dealers will not. Thank you for watching. Stay safe out there, and I'll see you in the next one.